Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. All right. Hello, and welcome to Yet Another Value Podcast. I'm your host, Andrew Walker. If you like this podcast, it would mean a lot if you could follow, rate, subscribe, review it wherever you're watching or listening to it. With me today, I'm happy to have my friend, Ross Levin. Ross is the Director of Research at Arbiter Partners. Ross, how's it going?
It's going well. Can't complain. How are
Ross,
things for you?
I am so excited to have you on. We've been, you're the one who turned me on to this. We've been talking about these ideas for a while. They're very different, but I'm really excited to present them. But before we get there, I know you're probably going to have to add on to this, but just a quick disclaimer to remind everyone, nothing on this podcast is investing advice. That's always true, but it's particularly true today. We're going to be talking about, I say a little, but actually a lot smaller, more illiquid, off the run, international security. So everybody should just remember every word I just said carries an extra degree of risk that everyone should remember when they're, doing their research. This isn't investment advice. Please consult a financial advisor. Ross, all that out the way. I know you'll probably have to add something, but the things we want to talk about today were kind of French. How do you call them? It's French, not convertible prefers, but
certificate cooperative d'investissement, cooperative investment certificates.
There you go. People who are familiar with kind of trust preferred securities in the US might know about them, but I'll let you give the overview and your disclaimer. So I'll just toss it over to you.
Sure. Let me just pronounce the blessing provided by my compliance officer. This discussion is, of course, not investment advice, and investors should consult their own advisors prior to making any investment decision. Arbiter and its clients currently own the securities we'll be discussing and may buy or sell them at any time. And we undertake no obligation to correct, update, or supplement any statements made in this discussion. With all that out of the way, yes, I'm happy to discuss with you today the Certificat Cooperatif d'Investissement, which are issued by the regional banking affiliates of the Credit Agricole group. I think most viewers of your podcast would be more familiar with Credit Agricole SA. That's the corporate and investment bank that's got the most liquid listing. It's got the symbol ACAFP. It houses the corporate and investment banking operations of the Credit Agricole group. It houses all of the international and insurance operations of the group, and that's the entity that has the big headquarters over on 6th Avenue here in New York. That's indirectly an investment via the Certificat Cooperatif d'Investissement, or CCIs, as I'll refer to them, but it's not really the main course. What a lot of people don't necessarily know about the Credit Agricole group outside of France, although those within France would be quite familiar, is that the main and historical business of the Credit Agricole group is a predominant retail banking franchise within France. That's a business that goes back into the 19th century, and it is a business conducted by 39 regional banks, which are predominantly mutual in their ownership. The corporate and investment bank is often discussed as the holding company or the mothership, but it is in fact not. In point of fact, the 39 regional banks collectively own 60%, the majority of that corporate and investment bank. It is essentially a minority stub that is the main listing, if you will, of the group. And in fact, the regional banks have recently disclosed plans to increase their stake by about €1 billion and take it up possibly as high as 65%. So the regional banks that we're involved in are predominantly mutual. Most of them have no public listing at all. However, a subset of them, which now number 13, issued, for the most part, several decades ago, a form of non-voting participating equity. These are the CCIs. They issued this paper at a time when the situation facing the group was quite different, and when the macroeconomic environment was quite different. They issued this paper at a time when interest rates were quite high. I mean, by historical standards, not by the standards of the last decade. They issued this paper at a time when the group and the regional banks were fairly thinly capitalized. They had been somewhat decapitalized by a prolonged period of inverted yield curve, much as the U.S. savings and loan sector had been up till that time. And they issued this paper partly to finance the buyout from the government of what would become the Credit Agricole corporate and investment bank that we know today. They sold this paper out of the bank branches to their retail clientele, almost, literal sort of mom and pop investors. It never had a sell side coverage of any note. It never had a buy side, institutional constituency of any kind. It was sold in fairly small lots to many thousands upon thousands of shareholders. But over the ensuing decades, a few things have changed. Number one, the compounding of the equity or book value of these instruments and of the banks in general has outpaced the growth in their balance sheets, or indeed in the French economy, such that they have become quite overcapitalized. And by that, I mean almost preposterously overcapitalized. The regional banks at this point run CET1 ratios of around 25% on average, with some north of 30%. Those are the sorts of numbers that we would associate with maybe a second step demutualization in the States.
I was thinking this. For people who aren't super familiar with banks, I mean, like a JP Morgan would have, from the top of my mind, they'd have like 14 or 15% set one. And JP Morgan's considered well overcapitalized. The government, because they're so big, says, hey, we take a well overcapitalized bank and we add 2% to you and all this sort of stuff. So most of the banks people are familiar with are probably in the like 10% range, right? Which is about 1 to 10 leverage. And that's kind of normal for banks. So 25% is like, you're basically all equity. You're approaching all equity. It is wildly overcapitalized.
That's correct. You're also in an environment where, even with interest rates, materially higher than they were a few years ago, participating equity capital is still relatively expensive compared to other means of funding a bank, in a way that it was not several decades ago when this paper was issued. The third thing that's kind of changed is that these instruments, which traded at around book value throughout the 1990s and the early 2000s, came after the GFC in 2008, 2009, and then sort of the European sovereign echo in 2011, 2012. They came to trade at extremely large discounts to their book value or net assets. The discounts are now running approximately 80%. So they're trading at 20% of a book value. And that's a book value that's grown 7 or 8% per annum over the last 10 years, over the last 20 years, and over the last 30 years. So these are kind of compounders that are trading at a huge discount.
Yep.
They also happen to feature what is at current market prices a fairly considerable dividend yield of about 5%. So the combined compounding rate is well into the double digits at current pricing.
And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are. And you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Perfect. So let me pause there. So basically how people can think of it, you have these small, illiquid, pretty much off the run securities that were sold to retail investors in the early 90s. I think a lot of people are familiar with people made fortunes going and buying when all the communist countries were demutualizing and giving their citizens literal stocks. And people would go like, hey, I'll take those 500 shares of the local oil company you've got for this bottle of vodka. Like, this isn't quite that, but these were very much sold to retail citizens, and they kept them in their bank accounts and they're for 30 years or so. You've got these off the run illiquid securities and massively overcapitalized banks. So I guess there's two opportunities here, right? Oh, and I should just say, I'm really excited for this opportunity, for this idea, but it is difficult to provide tons of pushback because so many of the documents are in French and people can read those. But there's two opportunities, right? This could go one of two ways. Way number one, what happens if you and I, and again, we're not providing investing by, but if we buy today, what sort of dividend yield are we looking at, and kind of how would that trend if these were never called and we just kind of had a perpetual preferred that we bought right now?
So if you buy them today, you get about a 5% dividend yield. Over the long term, that dividend yield has tended to grow along with the earnings of the banks. Over the recent past, the growth in earnings has been very limited because they've been sort of wrestling with compression in NIMs. For some technical reasons, the French banking sector is a little slower to recover in terms of its NIM than some of the other Eurozone economies. So it's not Ireland, it's not Italy, where the politicians have recently announced that they're going to take a bite out of what are seen as excess NIMs from the Italian banks. Rather, there's a bit of a lag in the recovery of NIMs. But nonetheless, I would expect over time those dividends to grow along with earnings. The Credit Agricole regional banks have undertaken fairly explicitly, but at the time of the Corporate and Investment Bank IPO, and more recently as part of an arrangement with the AMF, which is the French securities regulator, when they bought out the Corporate and Investments Bank's stake in the regional banks, they've undertaken to pay out 30% of their nominal earnings in dividends. And while they have stuck to that commitment, it is worth noting that the nominal earnings are understated by about half, such that the effective payout ratio is 15% or so. My general sense is that when you buy a yield instrument at a mid-single digit dividend yield, but at a 15% payout ratio, you tend to do pretty well.
But just so to be clear, like, one of the things I even said mistakenly at the front is perpetual prefs, right? And I can point you to a lot of US banks that have perpetual prefs that are trading for 60% of face value because, they were issued when interest rates were zero. So they've got a 5% fixed coupon. Interest rates have gone up and they've got a fixed coupon. So that's great capital for the bank. In this case, the dividend is based on a percentage of earnings. So assuming earnings are going up, which, it should happen one way or the other because the bank's retaining a lot of capital, so earnings should go up. The dividend's based on that earnings. You should have a growing income stream over time.
That's correct. And the compounding rate of the capital exceeds the stated ROE of the banks because the majority of the capital in these banks is mutual capital that, like in a partially demutualized thrift holding company in the United States, is taking or in this case, a de minimis dividend, such that the external kind of capital, non-mutual capital, realizes a growth in capital that is higher than you might infer from the ROE less dividends. There's also a couple other sources of incremental compounding. One is that the regional bank's ownership in the Corporate and Investment Bank, which in aggregate is 60%, is individually not a controlling stake, so they don't fully consolidate or proportionately consolidate the earnings from the Corporate and Investment Bank. They only record the dividends from the Corporate and Investment Bank as income. So that results in an understatement of earnings from that source of about 50%. And furthermore, and this is sort of important to the catalyst that's brewing, in 2016, the Credit Agricole Group announced a transaction whereby a cross-shareholding held by the Corporate and Investment Bank of 25% of each of the regional banks was sold back to the regional banks at 105% of book value. That's an interesting transaction for a few reasons, but it results in a understatement of earnings power capital buildup because, again, because they own this 25% stake collectively in each other, they don't reduce their share count by the 25%. They essentially only record the dividends on that 25% ownership in each other within their reported earnings.
There's something about France and these, like, I know so many people, and it's actually works out pretty well, but like the Boyer-Odette situation where like Odette owns shares of Boyer owns shares of Odette, but because they own them in each other, they can't cancel them out. And you have to like do all this. It reminds me of Russian dolls, like Russian nesting dolls. It's like, why can't these guys just start canceling out shares and stuff? It'd be so much easier. So I guess door one,
yeah, we do. I have to admit, we have a bit of a weakness for those sorts of complicated cross shareholding structures. We sort of have the view that if, there must be a pony in there somewhere.
Okay. So door one is I'm buying this way overcapitalized preferred yielding security at mid-single digits, and that yield should grow pretty nicely because, again, they're paying out a percentage of earnings. The earnings are growing nicely because of returns on equity, because the returns on equity are boosted by the mutual capital, all this type of stuff. So that's door number one. And that would yield, you can tell me if I'm wrong, it probably yields like IRRs in the low double digits if we follow that. It might even be better. But then there's
basically the compounding of book value 7-8% a year plus the dividend stream 5% a year less whatever relevant tax or fee drag you might have.
Yep. But so that's door number one, and that's a great door, right? Overcapitalized, pretty safe-ish security going for low double digits all in return. That's it. But I think the most interesting point is door number two, which is what happens if the catalyst that you talked about is brewing comes to pass. So I'll just flip it over to you. What is the catalyst and what is the history there?
So that transaction I mentioned earlier, back in 2016, they call it the Eureka transaction, where the Credit Agricole regional banks bought out the stake that the corporate and investment bank had in them at 105% of book is an interesting transaction. It catalyzed a degree of dissatisfaction among the still predominantly retail shareholder base of the CCIs. The majority of the CCIs, if you can believe it, are still held by the original purchasers. So the annual turnover is roughly 10% of what's outstanding, but there's a fair amount of repeat business within that. The majority of these have never actually turned over, and the majority of the supply, as far as we can figure, is essentially demographic, meaning people who are annuitizing at retirement or trustees sort of liquidating estates and things like that. So those folks actually had not had such a bad time of it. In price terms, they've had more than a double over the last few decades. But if you include the compounding or reinvestment of dividends over that period, they're up maybe 5x over the last 3 decades, which is not an amazing IRR, but it's a pretty decent compounded return for retail savers, and it's been fairly tax efficient for them. So they weren't wildly unhappy, even though these sort of discounts had emerged through the fact that the book values had grown much faster than the prices. However, when they saw the corporate and investment bank, the Parisian investment bankers getting taken out at 105% of book, while their recourse to liquidity was to sell to opportunistic and in some cases, disagreeably international.
Sell to people who are possibly recording a podcast currently.
In fairness, our investors in general are very likable people, and some of them are even sympathetic, endowments and foundations and the like. But nonetheless, the retail shareholder base, which had been very quiet and sleepy and still remains to a large extent sleepy, was able to be roused, if you will, by the perceived unfairness of that transaction.
Yep.
There had also been some favorable changes in French law over time, most particularly in 2008. And there is also this sort of mounting overcapitalization. And there has also been a trend across French mutual banking, including the Credit Agricole group, to eliminate via fairly fully priced redemptions or buyouts non-mutual capital of otherwise mutual groups. So you put all that together, and it afforded a group called ADAM, Association for the Defense of Minority Shareholders in France, ourselves, a couple of French institutions, and a large number, albeit a tiny minority of the total number of French retail savers, to organize around a campaign to seek the redemption of these instruments at book value. That campaign has several legal arguments or angles. It also has an economic logic in that these instruments are fairly expensive capital, and in any event, they are dramatically excess capital at this point, though again, they were not always. And furthermore, it's got a sort of a cultural element in that for most of the history of the Credit Agricole group, there was not non-mutual external capital of the regional banks. Most of the regional banks don't issue this form of non-mutual external capital. And the other major mutual French financial institutions have taken out analogous forms of capital. And furthermore, two of the regional banks of the Credit Agricole group, which had been issuers of this form of capital, bought out all of their CCIs shortly after large discounts emerged back in 2009, though that was before the Credit Agricole group ran into some issues in Greece and had to spend a number of years licking those wounds.
And just correct me, I want to go into all this, but just correct me if I'm wrong. These CCIs were generally sold, like they're sold by the regional mutual, right? But it means they're generally sold geographically, right? So if you're the regional mutual in northern France, you would buy from the regional mutual. And if you're in the southeast, you'd buy from the southeast. And I do think, and we'll address all the things, I think there is an element of fairness to it, right? Like we have had several of the mutuals, as you said, take out these CCIs. And it seems a little unfair. Like if my grandma bought CCIs in Northern Europe, for her to have her CCIs kind of languish at 20 or 30% of book or whatever it is. Whereas if your grandma bought them in Southern France, she gets taken out at par one day just because she bought from, she bought 20 years ago and she gets taken out at par just because that bank decided it's the right thing to do, and they're all kind of interconnected, and we can address that as we go on.
Yeah,
but
there's a bunch of sort of fairness arguments in the sense that these are the clients of the Credit Agricole group, and they were put into these securities by the. And
Credit it's a mutual, so they're also the owners of the Credit Agricole group, one way or the other.
Exactly. There's also sort of equity arguments, if you will, from one region to the next. Why is one group being afforded an exit at a fair price while another is not? I think there are also questions of reputation that are very important here and are likely to become more so. The Credit Agricole group seeks to build up a business in private banking. The Credit Agricole group controls the predominant asset manager in Europe, Amundi, which is, if not the BlackRock of Europe, certainly aspires to be. So there are reputational issues around that. I think there are also reputational issues around running a regulated financial where you have elements of your capital structure trading at enormous discounts. I think it introduces, as we've seen with Credit Suisse, an unnecessary vulnerability to the narratives of
You mentioned Credit Suisse, Western Alliance. Now there was all sorts of stuff going on, but their stock dropped from 60 to 8 in a day. And, a lot of people say, oh, it's just the stock price. It doesn't matter. And if you're running Apple, yes, it doesn't matter if your stock's down 50% in a day or not. You might have some disgruntled employees with their stock options. It doesn't matter. Western Alliance, they literally said, hey, our largest customers were calling us up and being like, we've got to move our money. Like your stock price is telling us you're going bankrupt. We've got to move our money. When you're a bank and you've got something trading at 20% of book, you are reliant on the capital markets. And that 20% of book, eventually it can come back to bite you. Your Credit Suisse example was a great one as well.
Now, in fairness, we're certainly not thinking that an outcome like that is likely here. We're long, and this is one of the best deposit franchises in all of Europe, much less in France. and these are some of the most overcapitalized financials of scale that we're aware of. So, it's certainly we think a theoretical rather than a practical vulnerability, but it's one that I would presume the Credit Agricole management is quite sensitive to.
Yeah, it's just, I think as finance creatures, value investors, you can say, oh, the stock price doesn't matter. And 90% of the time you're right. But when you've got something that's capital markets dependent, like a bank is, it's the 10% where you can be wrong.
It also creates some vulnerability to changes in capital treatment.
Yep.
To the extent that that a portion of your capital structure is subject to some form of dispute or ambiguity. We saw that with trust preferred securities in the United States, or with discos, which were an earlier form of kind of COCO-like security in Europe. There's been a tendency for these legacy instruments to get cleaned up as a matter of kind of good regulatory and ratings agency housekeeping.
So let's give some. So we've talked about the cleanup. I want to both talk about what a cleanup of these would look like, and there have been some historical examples, as you mentioned, and kind of point to those historical examples.
Yeah, sure. So, a cleanup, the aggregate amount of CCIs outstanding in terms of their book value or their net assets or their claim is roughly 7 billion euros. Now that 7 billion euros is trading in the market at roughly 1.4 billion euros, 20%. And I should mention that these instruments trade some off exchange through crosses among French brokerages, but they do have quotes on Euronext Paris, and they do trade consistently on the Euronext.
We haven't mentioned one yet, so why don't we mention one or two, just both so investors can go look at them and know what we're talking about, what we're pointing to.
Yeah, sure. So two of the more liquid names are CNDF FP, Credit Agricole Nord de France, or CAF FP, that's Credit Agricole Île-de-France. One of the more amusingly tickered is CRAP FP.
Look, Ross, you come on the podcast first time and you're going to pitch crap to the audience.
There may be a pony in there somewhere.
So CNDF, I'm looking at CNDFP. It trades today. You and I are talking August. What is it? Is today August 5th? I can't remember. 8th, August 8th.
All day.
We're talking August 8th. It's traded about 750 shares at about 13.30 euro per share. So could you just give an example of where is the stated book value, or would the book value of this be?
The book value is going to be about 5.2 times that figure. So I don't have it in front of me, but it's 60 euros or so.
Okay, great. So book value is about buybacks. It's got a dividend yield of about 4%, as we talked about, and that should grow as the earnings grow. Okay, so let's go to examples of historical kind of buyouts of these CCIs. How have those tended to trade?
Well, so two of them, there have only been two. That was in 2009. Both of those buyouts occurred at around 80% of book value and required a 2/3 vote of the CCI holders to approve the takeout. So those are the two buyouts sort of in toto of CCI issues by Credit Agricole regional banks. The other major corporate finance transaction within the group is that 2016 deal where 25% of each of the regional banks was bought back by the regional banks at 105% of book. There are also ongoing buyback programs by all of the CCI issuers. I would say, though, that only 4 of them are, really very material at present. But that number has been growing. A couple of years ago, or 3 years ago, we would have said that only one was a material, repurchaser, and so there does seem to be some recognition of excess capital and the discounts as sort of an attractive corporate finance opportunity on the part of the banks. There have also been a number of other transactions in other French mutuals that are kind of important. The BPCE group bought out all of its CCIs, which had been owned by Natixis, which was then publicly traded. I believe that transaction was at 105% of book. That was in 2013 and sort of kicked things off. But there have been a bunch of subsequent transactions where public stubs of otherwise mutual entities got bought out. Credit Mutuel bought out the publicly traded stub in one of its central entities, the CIC group. That was CICFP. There was a buyout of Losindis, which was a leasing affiliate of Credit Foncier. So there, and each of those transactions occurred at about 105% of book.
And you mentioned that some of these banks are trying to buy back their shares. What does the buybacks look like? Because given the low liquidity, I'm guessing they're not going on the open market and trying to execute like a 10b5 buyback or something. Are they going door to door and knocking on people's doors and saying, hey, if grandma has some of these prefs from 30 years ago, we'll take them off your hands?
Yeah. Sorry, by the way, I misstated the ticker of the CIC group. It was actually CCFP. And I should know that because we owned it. So the manner of the buybacks for the CCIs is unfortunately in the open market.
It is, okay.
And the reason that that's unfortunate is that the AMF rules on open market repurchase programs are fairly restrictive in terms of both percentage of volume and the ability to lift offerings. And so they are dramatically constrained by the open market daily volumes. So you'll have a CCI issuing bank announce their ambition to purchase maybe 6% of the outstanding CCIs, or as much as 10% in a 2-year period, or even a 1-year budget, and then you'll find that they come up dramatically short. Yep. Because that 6% or 10% ambition represents 60 or 100% of the annual on exchange volume. There have been some indications that they would be more aggressive if they could, but those are hints and emanations.
That's it. I mean, a buyback, again, if they're paying out 30% of their earnings as dividends to the prefs, buying back these prefs at 20% of face is hugely accretive, because you buy it back at 20% of face, your remaining group gets a greater share of that 30%. So it is just hugely accretive to do that. Let's talk about risks here, right? So risk number one would be, hey, Ross is crazy. These companies decide never to call these away. And I think we've addressed that. Hey, you'll just do the, assuming the math is right, 5% dividend now plus 7 to 8% compounding of capital for all the reasons we discussed. So let's put that risk to the side. The other two risks that would jump out to me are, or I guess it's just one big risk, but these are banks, right? They're overcapitalized now, but they're French banks. You mentioned Italy's taxing banks. It's not like France has never seen banks blow up. Europe's never seen banks blow up. How do you think about that risk, or any other risk that you see to these?
Well, I mean, I suppose there's some risk that under some future political circumstance, France could, leave the euro, or the euro could break up. I don't frankly know that I'm adding much value to those sorts of speculations. France is a country that did, nationalize its banks within the memory of those now living, if not those on this call. The nature of the precedents around bank nationalization in France are such that if that were actually to occur, we would likely be excluded, because the Credit Agricole group as mutual entities didn't participate in those nationalizations, although at the time they didn't have these capitalistic external securities. Secondly, if a nationalization were to occur, it would be a home run for us in terms of the likely valuation at which that would occur. So I think our mid-end risk is pretty limited. These are fairly conservative lenders. They only lend within their particular regions of France. They're typically lending on single-family homes, and there's not much of a housing bubble in France. They lend they do sort of local C&I loans and some local municipal lending. We really haven't seen much in the way of troubling credit issues in over multiple cycles. So in that sense, I think we're somewhat sanguine. If there were a dramatically inverted yield curve for a long period of time, that would be, troublesome, because these are sort of classic banks that, take in shorter term deposits and lend longer term fixed. That's something of a generic risk. I think the principal risk that we have, had to manage and underwrite is the time horizon.
Yeah.
And the moderate liquidity. So you really need to line up either the sizing or the nature and terms upon which you're bringing capital into the investment with a potentially long and uncertain time horizon for a what we think is likely to be a highly favorable workout.
One person who I was talking about this said, he was like, I've never seen, and again, nothing on this is financial advice, but he was like, look, I've never seen something where the base case is so clearly like low to mid double digit IRRs. And then one day you'll just wake up to like a 3 or 4x in your portfolio. And that is not investing advice, but that's how someone described it to me. I was like, oh, damn, it's a pretty good podcast pitch. Well, let me
offer another potential sort of, bear case.
Oh, I was coming out with some more, but yeah, please go ahead.
No, which would be that, the yield on the Credit Agricole Corporate and Investment Bank is about 9%. And that's the yield because it generates a very healthy ROE, both nominal and actual. And it trades at a modest, discount to its book value, and it has a 50% payout ratio.
Yep.
So perhaps, another bear case in terms of valuation more so than fundamental drivers is, if these things trade at a 5% dividend yield and you can buy something that's more liquid and has the same label on the can at a 9% dividend yield, maybe that's your downside.
Yep. So kind of the opportunity cost downside, like, hey, as you said, get a higher dividend yield, maybe not the huge discount to book, but you get a much more liquid entity that you've kind of got a lot more visibility into the business. Let me ask, speaking of Credit Agricole, right? So when we buy these CCIs, we are buying issues from the regional mutuals. So I guess my question is, if I buy in Northern France and Northern France blows up, I do know all the regional mutuals own stakes in each other, and that's kind of some of the circular happening. But if Northern France blows up, do I have any recourse to all the other ones, or do investors who are looking at these really need to think about, like, read through the balance sheets of the specific regional ones to really understand how each individual one's looking?
From an equity perspective, they are, independent of one another, and in their lending and deposit taking functions, they are, independent in the sense that the country is divided regionally and there's no sort of crossover. However, they do share in common a stake in the Corporate and Investment Bank, which on average represents perhaps 20% of their equity. And they do share in a cross shareholding in each other, which represents about 25% of their equity. And then on top of that, there is a systemic or regulatory undertaking to support each other in extremis, which is really more of a consideration for depositors than it is for the equity.
So basically, if there was runs on the banks, or we had another GFC, it's the, hey, we're not going to let our depositors take a haircut, but we'll absolutely zero out the creditors and equity if we need to. Let me just, along the lines of the whole group. So we've got the regional banks, and then you mentioned Credit Agricole. To what extent, if Credit Agricole, I'm not crazy familiar with their investment bank, but we've seen investment banks blow up on weird stuff before, right? And obviously, a lot of the regionals own equity in Credit Agricole. But if Credit Agricole went kablooey, what would happen to these regional banks in the regional press? Would it just be a hole in the balance sheet, but because they're so overcapitalized, it's doable? Or are they going to find out, oh, we've guaranteed a lot of these obligations and it's a systemic risk?
Yeah. Just for context, the group has about 105 billion euros in equity capital. And of that, roughly 44 billion sits at the Corporate and Investment Bank. And the balance sits at the regional banks. The Corporate Investment Bank runs a CET1 ratio that's more conventional, meaning 11.5%.
11.85.
Exactly. Yeah. So just to put sort of, some sense of scale on things, the Corporate Investment Bank does run a fairly large balance sheet. although most of it's fairly low risk, that wasn't always the case. Back in 2011-12 and into 13, the Credit Agricole group really did get itself into some trouble via its Greek affiliate, Ampariki. They weren't alone. There was something of a complete, totalizing financial crisis in Greece at the time. But because of the recourse to the parent, they ended up having to put in, billions of euros of support for that Greek entity, which left not the group, but the corporate and investment bank a bit thinly capitalized relative to what regulators post-crisis wanted to see. And so there were some valid concerns a decade ago that the regional banks might have to participate in some sort of a rights offering or substantial support for the corporate and investment bank. And while there was, some support, and arguably the Eureka transaction was effectively a means of transferring some capital to the corporate and investment bank, I think that sort of sensitivity is somewhat behind us. There has been a real retrenchment and reassertion of control of the corporate and investment bank's activities on the part of the regional banks. The corporate investment bank has emphasized lower risk and sort of balance sheet light, i.e., asset management business to a large degree subsequent to that episode. And the Credit Agricole corporate and investment bank, has really not given people cause for concern in recent years.
Let me switch to one more. Uh-oh, did my computer freeze? Nope, I think we're good. Sorry, my computer, I told Ross just before we started, my computer decided to blow up its battery. But I think we're fine. One more. So if, as an investor, you can go onto the Credit Agricole website and get financials for the overall group. If you're researching an individual one, how do you kind of do research on the individual side of this?
Yeah, you can go to the individual mutual issuers website and pull their filings. You can pull their filings from the AMF website, which is the sort of the equivalent of Edgar here in the States, or CEDAR up in Canada. You can also pull them down if you are a supporter of Michael Bloomberg.
I got mine from Bloomberg, but I just done a dumb search of, we mentioned CNDF, which is Ca Nord de France. I'd done a dumb search and didn't see anything online. So I was wondering if there was a way for the non-Michael Bloomberg donators to go check out the financials.
Yeah, no, they've all got websites, and the French language financials are available. They don't necessarily all offer English translation, but Google Translate is your friend.
Yeah, it's so funny. 10 years ago, I remember looking at the Japanese companies, and it's just so funny. Google Translate for financials, yes, it's not 100%, but it is just so good. It's really opened up the world for looking at foreign investments. And now, a quick word from our sponsor. Are traditional expert calls in the investment world becoming obsolete? According to Stream, they are, and you can access primary research easily and efficiently through their platform. With Stream, you'll have the right insights at your fingertips to make the best investment decisions. They offer a vast library of over 26,000 expert transcripts powered by AI search technology. Plus, they provide competitive rates on expert call services, and you can even have an experienced buy-side analyst conduct the calls for you. But that's not all. Stream also provides the ability to engage with experts one-on-one and get your calls transcribed free of charge, all for 40% less than you would pay for 20 calls in a traditional expert network model. So if you're looking to optimize your research process and increase ROI on investment research spend, Stream has the solution for you. Head over to their website at streamrg.com to learn more. Thanks for listening, and we'll catch you next time. Look, I think we've gone through most of my questions. Obviously, there's a lot more here. We've mentioned the 2 or 3 ones that were not financial advice, obviously, but people can go use to jump off and they can kind of follow those threads to find more. But is there anything you think we should have talked about, or people should be thinking about as they kind of think through these opportunities, or anything else?
I mean, obviously, there's a lot of different directions we could go. There's I guess an old saying, maybe from the muni bond business, that the yield, the incremental yield on a muni bond issue is about 20 basis points for every 30 seconds of additional explanation it requires. We're pressing on an hour, so maybe that's a good indication for the prospective IRR here. No, I think you've covered it reasonably well.
Let me ask just one more. I do think there is an element to, hey, if everyone who owned a CCI who was a local French resident contacted the bank, I was like, I'd like you to convert these. I do think the bank might be a little more receptive. Look, I'm a silly foreigner who I spent my first day in Paris 2 weeks ago, right? But can I contact a regulator or something to let them know, hey, you've got these shares outstanding at 20% of face? That doesn't make sense for anyone. Is there a way to kind of maybe self-catalyze that process a little bit?
Well, I think that an organized campaign of contacting a financial issuer's regulator is probably no way to make friends. What I think would be, more prudent would be contacting the Credit Agricole IR, because you'll find that the presentation to regulators and fixed income investors is very much about the Credit Agricole group.
Yep.
Because they wish to benefit from the perceived and real excess capitalization of the regional banks in their communications with that constituency or those constituencies. But when they speak to equity investors, they tend to emphasize the Credit Agricole Corporate and Investment Bank, and they sort of fob off the regional bank inquiries as sort of outside of scope. I strongly suspect that as the yawning discounts on the Credit Agricole regional bank equity in the form of CCIs come to be seen as a distraction verging on a problem for the Credit Agricole SA equity, or for their discussions with ratings agencies and fixed income investors, this situation will resolve itself more readily.
So, and I like you said, contacting regulators is never a way to make a friend. You are definitely right. But if investors are interested in this, I think if they are interested, they do work, they should consider reaching out to the Credit Agricole Investor Relations and just saying, hey, 20% of book value doesn't make sense for anyone here. Yeah. Some type of cleanup could probably, there's a mutually beneficial situation that can do everything here. Cool. Ross, this has been fantastic. Again, I wish I spoke French and had deep expertise in kind of French securities law, but I just think this is an absolutely fascinating idea that, again, I think in terms of risk returns for people who are willing to do the work, put up with a little illiquidity. Nothing's financial advice here, but I think it's a really, really interesting situation. So, yeah, Ross,
it's perfectly fun to do a desktop analysis, but I'd strongly recommend you take your significant other on a diligence tour. There's plenty of nice places to visit throughout France.
I told you, because you and I met up for lunch just before. I just went on the baby moon and we spent a day in France. And I hear you, but I actually preferred Barcelona. Not to be too dismissive of an interesting idea, but we can talk about my preferences for European culture sometime else. Ross, this has been great. We're gonna have to have you back on I know we've got Irish banks we could talk about. We've got demutualizations we could talk about. Ross is an expert on all things financial, so we'll have to have him back on in the near future.
Thanks for the time.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.